Well, I am not going to go back and start from the beginning, all right? I'm sorry for those that aren't here today. I have started recording now. Um, and so, yes, thank you for the reminder. I wish I would have checked my mess. Actually, I didn't even see that. I've closed everything and my PowerPoint is overtaking both my screens. So there you go. All right, whatever. We're going through the process of receiving inventory, and we want to make sure we have a blind receiving report, because if not, the person who's checking in that inventory would sometimes just make the assumption, right? Oh, and I think I shared the story about my boss, Tony Moniz. T-shirts were delivered in boxes of 144. And so Tony would lift up one of those boxes and say, it feels like 144 to me. And he wouldn't count them in. And I'm like, dude, you got to count those things in, all right? Because first of all, maybe they shorted us, right? And in that same process, we also have the control over quality, right? Because if there's a defect, right, that's when we're going to catch it. We don't want to be waiting a couple weeks before we open up that box and realize, hey, there's a defect in this. And you know, in our case, we had good relationships with our suppliers and they would trust us, all right? But you know, in some cases that may not be there. So you want to catch those errors or lack of quality in advance. So receiving, all right? Yeah, determines the quantity of goods received, hopefully using a blind, you know, so they count those things in, looks for damage and defective merchandise, prepares the receiving report, and they prop transmittal of goods received to the stores department or, you know, to the inventory manager. When it comes to storing, right, counts, inspections, and receives goods, notifies accounting of receipt, right? And so this obviously is a large organization. We didn't have all these steps at Faith Writing Company, all right? But yeah, I mean, again, we have segregation of duties between the receiving department and also the storing department. Physical security of inventory, all right? And so that's really where we're applying the preventive controls, right? Limiting access to that inventory. Issuing and or production. Storage department issue goods to requesting departments, all right? Again, utilizing pre-numbered requisition forms, pre-numbered purchase orders, pre-numbered invoices and whatnot, all benefit in the completeness, right, function of this audit. When it comes to production, all right, controlled with a master production schedule, all right, production orders, materials requisitions, and move tickets, all right, and then job time tickets. All right. So again, you know, what we learned from either managerial cost accounting, accounting 214, or from managerial accounting and accounting 202, all right, you know, this whole flow of inventory from raw materials to work in process to finished goods. Shipping, all right, shipment upon authorized sales order, all right, you know, so this is the distribution of that inventory. First of all, we want to make sure that if this was purchased on account, that there's proper, they have proper approval, right, as far as the credit limits. Generates a pre-numbered shipping document, right? One copy stays in shipping, one to billing, and then the third party, right, uses as a packing slip. For goods shipped, common carrier, all right, a fourth copy for services as a bill of lading. Cost accounting, all right, accounts for the usage of raw materials, determines the content and value of goods in progress, and computed finished inventory. All right, and so again, you guys remember, you know, we had materials, work in progress, and then finished goods. Right, and so when we purchase materials on account, right, through the whole purchasing and receiving process, all right, you know, we have direct materials and indirect materials. And then based on the materials requisition form, we take some direct materials out of here and we bring it over here to work in process. Probably have some indirect materials going down to our factory overhead. So we're debiting work in process, crediting materials, debiting factory overhead, crediting indirect materials. And then once we're finished with this, job 1 is done. We send it up to finished goods, job 1. Okay. And then when we sell finished goods, all right, it goes to our cost of goods sold, job 1, and so forth. The flow, all right, of inventory. Perpetual inventory systems, all right, are great. They're the best. All right, very few people don't have perpetual inventory. If you have a computer, you're using perpetual for the most part. The reason being is that it has built-in controls, all right, because we're continuously updating our inventory and recording our cost of goods sold. Whereas periodic inventory, we don't know what that is unless we use the gross profit method to estimate it, or if we actually do a physical inventory. Know, however, that even though we're using perpetual inventory, which again, hopefully you guys have learned at this point, right? Because no joke, I had this problem or this journal entry, I think it was in managerial cost accounting, is, hey, record the sale of inventory, right? And of course they do accounts receivable, cost of goods sold, all right, and then sales, or some derivative of that. That is not, all right, the proper journal entry. Under perpetual inventory, we're always making 2 journal entries, right? One to record the sale, accounts receivable, sales, and then one to record the expense, cost of goods sold, and our inventory, the using up of our inventory. Okay. All right, you always have to have 2 journal entries for the sale of product under perpetual inventory. Allows companies to control high costs of holding excessive inventory, because with perpetual, it's easier, okay, to run just-in-time inventory. Again, just-in-time inventory eliminates needing to carry large quantities in a warehouse somewhere, right? And that it allows us, to have a economic reorder point and reorder quantity. Hopefully you picked all that up in Math 129, all right? But yeah, so that we don't have to carry a lot of inventory on hand, but yet also not miss out on sales. So IT systems, easier to control inventories, coordinate production and purchasing. All right. Risk assessment for the audit of inventories. Okay. Use the understanding, again, this is that mantra, use our understanding of the client and its environment to consider inherent risks, including fraud risks related to inventories and cost of goods sold. All right. Obtain an understanding of internal control over inventories and cost of goods sold. Assess the risk of material misstatement and design further audit procedures. All right. So how many of you guys ever worked corn detasseling? Or have you guys ever worked in agricultural crops or whatever? Shelby, I don't know who that was, but I think isn't that your associates? All right, Shelby, an ag business or something? I don't know. Well, let me relay the benefit of corn detasseling, right, to your job in auditing, especially, all right, if you are auditing Dole pineapples, all right. So probably the best job I ever did, all right, as an auditor was actually auditing Del Monte. And my skill set did not come from my auditing class, right? My skill set came from working for Pioneer, doing corn detasseling. See, with pineapples, It is basically a production process, right? Where you start with a the planting, right? Which I don't know if you guys knew this. If you have a pineapple that you buy in a store and you cut off the top and you bury that in the dirt, okay, it will grow, all right? Because that's for the most part, all right, how they plant new pineapples. They just take the tops off the old pineapples and then replant them. All right. I didn't know, or maybe you didn't know this, but pineapples are actually a flower, right? That the pineapple plant produces. All right. So it's an edible flower that we're eating. Well, my colleagues just were clueless, right, when it came to understanding the agricultural process. So you plant the plant, you add additional costs, things like fertilizer, water, because these had automatic water lines and whatnot, and stuff. And so you have all these costs that are going in, they're accumulating, all right, in the growth of this plant, right? But then, all right, these plants, and this is what most of my colleagues had a hard time with. These plants could produce what is referred to as a routine, right? It's when they actually produce. So they one plant, actually, I think they can do like 5 routines, but they stop it after 3 because the quality of the pineapple diminishes, right? But basically, one plant produces 1 pineapple, and it can do 3 seasons, right? So it can produce 3 pineapples in its lifetime, right? Now, thankfully, the seasons aren't in Hawaii. They are not as long as they are in the mainland here, all right? But I understood, and really that's what I'm trying to get. I understood, the process of agriculture as it related to Del Monte and their pineapples, all right? And so I got, I didn't get a bonus or anything like that, but I definitely got acknowledgement from the partner, and who just said, "Man, you did a great job," and the client even said, "You did a great job." So, be able to draw from your hopefully vast work experience, even if you think it doesn't count, right? Things like corn detasseling with Pioneer. All right, so risks of material misstatement. All right, so again, I love reading all these things, and hopefully you do too. All right, but I'm not going to read them all. All right, the ones that are more interesting are the frauds versus the errors. Okay, but misstatement of inventory cost. Right, the intentional misstatement of production costs assigned to inventory. Right, the intentional misstatement of inventory prices. Right, so if you remember, the whole concept of lower of cost or market of our inventory. This is where we're maybe not applying that, right, or using inaccurate numbers to commit fraud. Misstatement of inventory quantities, right? So we're looking at costs, and now we're looking at quantities, right? So saying we have more than we actually do. There was another, and I think I've already shared this story, so I'll make it short, all right? Another client of Coopers and Lybrand that actually was going through a lawsuit when I worked for them, was that client who was artificially filling boxes for hard drives, right? They're filling boxes with bricks with hard drives. They're artificially inflating their ending inventory, which would then deflate their cost of goods sold, which would inflate their income, then meeting the targets that were expected targets, right? And so, the manipulation of quantities. And then cut off, right? This happens quite frequently again. The intentional recording of a purchase in the subsequent period, right? And so, in effect, ineffective board of directors, audit committees, so when we identify that sort of fraud, it's probably escaping detection because of an ineffective board of directors or an audit committee, and so on and so on. Further tests of controls, all right? Perform perform further audit procedures, test the controls. Example of test controls: examine significant aspects of a sample of purchase transactions, right? And so, go to the purchasing department, randomly pick things out of the drawers there, right? And make sure that they are going into the system. Perform tests of the cost accounting system. If necessary, revise the risk of material misstatement based on these results, right? And increase your substantive testing. And so here, right, are the relating controls and assertions or over inventory. And so again, here's the, here's the, can you see that? I guess you can. All right. So here is the internal control policy and procedure, okay, the tests that are related to this. So really, this is an audit plan, all right, or actually, yeah. And so, these are the types of tests and what they are allowing us to see, right? The existence of occurrence, completeness, rights and obligations, valuations. And so, one of the areas that I haven't addressed yet were the whole FOB components, right? Because that dictates when title transfers. So FOB shipping point, title transfers as soon as the seller loads that product onto the delivery truck. Where FOB destination, title does not transfer until that truck is unloaded, right, at your facility. So again, you can read through those. Substantive tests, right, over inventory. Okay. Perform further audit procedures, substantive procedures for inventories and cost of goods sold. And so to check, so if there are weaknesses that we've identified in the internal control section, we're going to get more assurance or confidence by doing these substantive tests. Obtain a listing of inventory and reconcile with ledgers. All right, so hopefully you realize that when it comes to inventory, we're going to have subsidiary ledgers and control ledgers. Evaluate the client's planning of physical inventory, right? And so, are they doing the proper procedures? Are they using the right, so this is actually them going and counting these things. I loved this. I observe the taking of physical inventory, right, and make test counts. Right? And so I probably shared with you guys, if you were in my class, about the import-export business in Hawaii that would export Ghirardelli chocolate, right? And they literally would have pallets of probably 1.5 feet by 8 inches tall and half a foot wide or not of just solid bricks of chocolate, right? And so I always chose that one because it just smelled good. And so I'd count those chocolates. I'd have to open one of those boxes up and take a big chunk, just for quality control. I'm kidding, I did not do that. All right, but I did open them to make sure that there was chocolate in there, all right? And then we just retake it. Right? Review year-end cutoff of purchases and sales transactions. And again, what we're doing there is we're looking at the FOBs. Obtain a copy of the completed physical inventories, test its clerical accuracy. All right, so add them up to make sure that their math is right. All right, and then trace the test counts. All right, so there's usually tickets that you leave on the inventory. Right? Now, again, trust me, when you go out as an auditor, they will teach you how to do this. This is one of the most common things for first-year auditors, right? And usually there's a 2-year or 3-year there, because truth is, I signed up for everyone I could get, because I wasn't behind a desk and I could go to the warehouse and interact with the client and whatnot. So I enjoyed it. Evaluate the basis and methods of inventory pricing. Are they applying lower cost or market? Test the pricing of inventories. Right? Perform analytical procedures. Consider using data analytics. Determine whether any inventories have been pledged, right? And review purchase and sales commitments, right? Because if you remember, when it comes to inventory, there's the whole process is that your inventory? So inventory on consignment, if you're holding that as a consignment, that is not your inventory, right? Okay, that still belongs to whoever gave it to you. Evaluate financial statement presentation of inventories, cost of goods sold, and include adequate disclosure. And so again, here are the substantive tests and what they allow you to gain confidence in. And again, I'll let you read about that. Inventory observation. Client counts and supervises inventory. Okay. Auditors observe. Right? They determine all items are being included. Employees comply with instructions. Right? As the auditor, you need to be alert for inclusion of obsolete or damaged merchandise. So if they have a seconds pile or something like that, you need to make sure that that is not included, right, in the total counts, because we'd have to do a special valuation on that obsolete or damaged merchandise. Record numbers of final receiving and shipping documents, right, issued before the inventory taking. Make test counts, right, and make sure that inventory accounting includes procedures to determine that all items are included and none are included more than once. And so I mentioned earlier, utilizing tags. So once it's been counted, they have to put a tag on it. When the auditors are engaged after year end, right? So we're trying to again, work backwards to find out what the ending inventory was as of December 31st. So inventory verification, when the auditor is unable to observe taking of inventory at year end, right? It may conclude that sufficient appropriate evidence cannot be obtained to express an opinion. And so if that's the case, we're going to have to issue a qualified opinion. You could obtain satisfaction with alternative auditing procedures, existence of strong internal controls, right? So we're able to document and evidence, right, that they have good procedures over their inventory. We could look at their perpetual inventory records and see how those line up. And then documentation of well-planned and executed physical inventory. So we saw the instructions and procedures that the people taking the inventory were following. And then we make test counts, right, and basically work backward. All right, so we make a test count, let's just say January 15th, right? From their accounting records, we'd see if they sold any of that. Right? If that was the case, we'd add those back. Right? And then we would see if they purchased any of those items. Okay? And if that was the case, we would subtract those, coming back to what ending inventory should have been at December. Proper cutoff, right? Again, this is the FOB thing. Examined on a test basis the purchase invoice and receiving reports for several days before and after inventory date. Determine that a liability has been recorded for all goods in inventory. Okay? So the goods in transit, make sure that, hey, if we're counting that we're also recording the related liability for that. Make sure shipments and purchase orders are in proper periods. Inventory pricing, right? We want to definitely emphasize what method of pricing does the client use. Is the method appropriate? Is the method of pricing the same as that used in prior years? And has the method selected by the client been applied consistently and accurately in practice? Right? And again, the test of pricing inventories. Right? And so, this entails so much. All right, so inventory pricing, if you remember this, we talk not only about lower of cost or market, but also FIFO, LIFO, and average, right? And so hopefully we're using perpetual inventory, right, with FIFO, LIFO, and average, and that can actually be some complicated calculations, especially with LIFO when you have multiple inventory layers. And so here's an example of testing of inventory. Okay? And so, you know, they talk about the tests that they performed down here, and you know, the conclusion based on those tests, and again, the auditor's signature and her initials and dates. With data analytics, again, you know, utilizing computers, all right, to audit, you know, the computerized inventory system. Identify overvalued inventories by comparing cost per unit to sales prices or net realizable value. Again, net realizable value is well, actually, I was thinking of net realizable value for accounts receivable, but net realizable value would be the historical cost of our inventory, subtract the write down because of lower cost or market. It gives us the net realizable value. Identify obsolete inventory items by comparing actual and forecasted sales to numbers of items in inventory. Identify obsolete parts by searching for components of manufacturing parts that have been identified as obsolete. You know, so an example, you know, with that windshield wiper supplier, we had purchased some, you know, for the 2000 model car, but the 2001 model uses completely different size, right? And therefore, you know, we're not making any more of those. And so if we have inventory still on hand, you know, what is the value of that? Can we resell it in other markets or not? Identify overstocked, understocked inventory items by comparing the number of items in inventory to targeted stock levels. Identify high value items and their locations to be included in test counts performed during inventory observation. All right. Let me just share a fun physical inventory that I did. It was on a high-end jewelry store in Waikiki, right? And so Waikiki has all the high, you know, big name, high-end retail stores, and I actually got to do this one where I actually picked up a watch, right? They only had two of them, right? That was $350,000, right? Don't remember the name. It wasn't a Rolex, right? But it was ridiculous. And, you know, by observing those two items, $600,000, right? That gave me, you know, as far as a dollar amount, that gave me a high percentage, right, of verifying their inventory. You know, they did have other high expensive things, that, you know, necklaces and stuff like that, but for some reason the watches just stood out in my mind. Yeah, that was a high value thing. Identify inventories purchased without proper approval and ones that were or things that have related party issues. Presentation disclosure, right? Hopefully inventory, you know, you realize it's on the balance sheet, current asset. However, again, there's notes that are related to those numbers, right? And so we talk about the inventory pricing methods, right? FIFO LIFO average. We also include the fact that you know, we are applying lower cost or market. Other important disclosures, right? If we changed methods, right? Classifications of inventory, pledged inventory, deduction of valuation allowance for inventory losses, and then existence in terms of inventory purchase commitments. And that leaves us with our last slide, problems with first-year clients. Right? You know, so when you go in, you don't have, you know, the detailed inventory from last year's financial statements. Okay? To reconstruct that sometimes can be difficult. So procedures to obtain evidence that the beginning inventory was fairly stated. Okay? You're going to have to review the predecessor's working papers, discuss with a person who supervised physical inventory at the beginning, study written instructions in the planning of that inventory, trace numerous items from inventory tags to final summary sheets, and then test perpetual inventory records for previous year, and test overall reasonableness of beginning inventory. And so you know, to reconstruct the beginning or to have confidence, because, you know, if your beginning was overstated, all right, that's going to have the ramification this year of our cost of goods sold being understated also, right? And so there's a, you know, a 2-year turnaround process, you know, so 1 year's ending becomes the next year's beginning, right? And hopefully you guys remember that when you're auditing inventory, or if there's an error made in ending inventory, over 2 years it self-corrects, right? However, you know, for prior period restatement, we'd have to restate them with the accurate inventories. All right. Cool. Well, that's all I have as far as you know, chapter 12. And so let me. I will. Let me stop the recording.